Hey, and welcome to my channel Fiscal Voyage. I'm Felix, and in this video we're going to do a 5-minute stock analysis on Tesla. We're going to determine if Tesla at the current price a buy, hold, or sell. But first, if this is your first time coming to my channel, make sure to subscribe and leave a comment of a particular company you would like for me to analyze next. So with that, this video of Tesla was actually suggested by this Two Eyes. Thank you for leaving a comment and suggesting for me to do analysis on Tesla. So let's start. Okay, let's start with the 5-minute stock analysis on Tesla. It could be found in New York Stock Exchange as TSLA. Tesla, formerly known as Tesla Motors, is an American automotive and energy company based in Palo Alto, California. The company specializes in electric car manufacturing and through its Solar City subsidiary, solar panel manufacturing. It operates multiple production and assembly plants such as the Gigafactory near Reno, Nevada, and its main vehicle manufacturing facility at Tesla Factory in Fremont, California. As of 2019, Tesla sells Model S, Model X, Model 3 cars, and is accepting reservation for Model Y, Roadster, Cybertruck, and the semi-vehicles. Tesla also sells Powerwall, PowerPack, Megapack batteries, solar panels, solar roof tiles, and some related products. Alright, let's look at the fundamentals. Revenue grew at a compound rate of a whopping almost 80% from 2009 to 2018. However, they did not make any net income, so they didn't make any profit during this time period. Currently, that has an S&P credit rating of B-, and operating income was negative as well. On the bright side, net income and operating income looks to be a little better this year for fiscal year 2019, but it's still in a negative. Therefore, earnings growth, there's none because they haven't had positive earnings growth. And the 5-year revenue average has been decreasing, but not tremendously. It's currently at 61% for the 5-year average. For 2018, they did had a negative earnings of $1.33. Net margin came in at negative 4.55%. Return on equity negative 21%, and debt to cap currently at 60%, 59%. They don't have a dividend yield. Therefore, they don't have a payout ratio, and they haven't ever paid any dividends. You can't pay dividends if you're not making money. Positive net income. Therefore, there's no charter rule and 5 dividend growth average yield, and none of that there. Future outlook for this year, analysts expect a earnings of negative 40 cents for the year. However, 2020 analysts expecting positive earnings. So next year they're expecting the company to make some profit of about $4.81 a share. So that's good news. CFRA has a 3-year earnings projected growth of 40%. I can't do my dividend drill return model because they don't pay a dividend, so we skip this. And currently, they don't have a forward PE and 5-year PE average because they haven't earned a positive earnings per share. So we look at the fast graph. As you can see here, the black line is the monthly closing price. The orange line is the earnings PE multiple of 15. So you see that the black line, the monthly closing price, way above the normal PE. Like I said, it doesn't even have a PE right now because of negative earnings. So if we look at the fair price from different analysts, CFRA expects 213 as the fair price, Morningstar at 326, Simply Wallet at 216, and FastGraph at 185, and Yahoo at 295. Averaging out the 5, we get a fair value price of 247, which is way below the current price as of today at 432. Gives us a current price is overvalued at 42%, almost 43%. Therefore, I recommend this company as a sell. The stock actually reminds me a lot of the .com era in 2000 and 2001, where a lot of companies was very high multiples without even earning positive earnings per shares. So this stock kind of reminds me of that. I believe in the company. I love their cars, the design, what they changed the industry with the electrical cars. I love all of that. But for example, if 2020 $4.81 comes to true, and we give a PE of 40, which is a very high multiple, it'll be worth 192 and 40 cents a share. And if 2021 estimate of $9.98 came to true with a P of 40, it'd be worth $400. Averaging out the two, we get almost $295.80 with a PE multiple 40, which is very high to begin with. Right now the price is extremely high. The company, doesn't make any profit right now. I do believe in the company long term, but just not at this price. So that's why I recommend it as a sell. If you've bought the company before and made a lot of money out of it, that's great. But right now, I see it as a sell at current prices. I'm not buying today. Eventually, I would like to own the company because I believe in it, and I would like it to see succeed, just not at these prices. So therefore, if you have a company that you'd like to recommend for me to do next, leave a comment with the ticker symbol and the company name. And if you find this video informative, make sure to hit the like button and subscribe to my channel. And also, my portfolio is in the description. There's a link to it. And you can check my website as well, fiscalvoice.com. Have a great one.